cross-asset, cross-market volatility should spike, and the background of geopolitical volatility, currency volatility, which means world is not going to be stable in this period, and that's one of the precise reason in last 3 months our portfolio, if you look at, is more skewed toward defensive side, and we still maintain that this cycle has still not ended. Let's say FMCG as a space which has been underperforming for a while. Okay, that's a space we have built our exposure. Valuation was not cheap, but they started trading in the neglected territory, and hence that was the play.
FMCG looks good. There is election money spending, there is budget spending, and there is good monsoon. And stocks haven't done well for some time. Valuations are elevated compared to market, but around historical averages compared to their long-term trend. And hence FMCG is one place which will outperform the market. The market is moving so fast that in just about a month or so, FMCG companies have rallied. We still believe within FMCG, on a bottom-up stock picking, there could be opportunity.
Very bullish, the market as a whole, and there is a sector rotation happening right now, which really is the issue that I grapple with on a day-to-day basis. The issue is not about being in cash or being invested. I am fully invested. The issue is that the overweight in industrials and PSUs and defense has to now tilt slightly to IT, pharma and FMCG. Fantastic monsoon. So you're having record sowing. So the output is that you may have an excellent harvest. So I do think that the market is moving towards the rural driven themes. That is why, when we talk of FMCG and stuff like that, you will find that they're doing very well. Some of the fertilizer stocks are doing very well. So I feel the market's moving on a bigger play from a risk on to a bit of a risk off mode.
The valuations of all the sectors which typically used to trade at a big discount to the index have moved up very significantly. So to my mind, what's happening to some extent in both FMCG and IT is these sectors which typically held a very large premium to the benchmark have significantly eroded that premium, and actually you've seen a lot more, I would say, cyclical businesses which over time have tended to be cyclical not just in terms of growth but also in terms of their ROEs have actually moved up very dramatically in terms of valuation. So I think it's a little bit of a valuation normalization trade whereby, if you're going to start paying FMCG multiples to capital good stocks, then why not just look at the FMCG stocks where they may be rich but they are far more stable in terms of medium-term outcomes.